Welcome to RBC's Markets in Motion podcast, recorded September 8th, 2025. I'm Lori Calvasina, head of U.S. equity strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. The big things you need to know. First, we see Friday's weaker than expected jobs report as having added some additional uncertainty to the equity market outlook at a time when we've been on guard for choppiness for other reasons. Second, we reiterate our overweight stance on S&P 500 materials. Third, other things that jump out to us include the weakness in Bitcoin and deterioration in U.S. equity flows and retail flows specifically, which add to our near-term concerns. If you'd like to hear more, here's another 5 minutes. Let's start with takeaway number one. The jobs report adds uncertainty to the outlook. As we reviewed our weekly charts on Friday, we found we had difficulty focusing on much else besides the jobs report, in which August non-farm payrolls came in well below consensus at 22K and June was revised down to a loss. Our colleagues in RBC Economics noted in their recap that slowing demand in conjunction with slowing supply make interpreting the NFP reports more cumbersome and with less clear signal about the economy. While the U.S. equity market reaction was rather muted on Friday and decidedly not sending a recession fear signal, the release nevertheless adds to our own concern about choppy conditions in U.S. equities this fall. Our worries have centered on elevated valuations in the S&P 500 and NASDAQ 100 that are failing to break through the most recent previous peaks. The tendency of September and October to be tough months for S&P 500 performance over the past 5 years, and the sudden deterioration in AAII net bulls without a big break in the stock market, something reminiscent of early 1Q25. We also observed as 2Q reporting season wrapped up that S&P 500 company commentary on earnings calls has kept us in the camp that the real test from tariffs from a corporate profitability, inflation and cost pressure, and demand perspective is coming up in 3Q and 4Q. Post-Labor Day, we also noted that uncertainty around trade policy remains elevated as the lawsuit over reciprocal tariffs makes its way up to the Supreme Court, and we admittedly picked up a few breadcrumbs in our transcript reading pointing to the idea that the labor market has cooled, but for the most part, the labor discussion in 2Q25 reporting season was pretty light. That leaves us concerned Friday's jobs report may inject some fresh uncertainty about the labor market backdrop into an equity market that's been priced for perfection. Moving on to takeaway number two, we're sticking with our overweight on materials within the S&P 500. The second best performing S&P 500 sector on Friday after the jobs report was actually materials, a sector that we upgraded in early July when we published our mid-year S&P 500 sector outlook update. Since early August, materials has also outperformed the S&P 500, though it has not been at the top of the rankings. As we thumbed through our sector updates on Friday, we took note of both the better performance in August and the generally favorable signals for the sector on our top-down strategy tools. Most notably, funds flows have been positive for the sector with an improving trend. Valuations for materials also continue to look attractive in relative terms and in line with historical averages in absolute terms. Earnings sentiment has been a bit weaker than what we've seen in other sectors, but revisions remain balanced between positive and negative revisions on both EPS and sales. Moving on to takeaway number three, a few other things in our updates are adding to our nervousness, though ISM new orders was a bright spot. The MOVE index, a gauge of bond market volatility, has edged up slightly in September, though it remains quite low versus recent history. Meanwhile, Bitcoin remains a bit below its mid-August highs, even though the S&P 500 has crept up to a new one. This is concerning to us as Bitcoin and S&P 500 performance have been aligned in recent years. Though ISM manufacturing only moved up modestly and remained rather weak in last week's updates, we did see the stronger improvement in new orders, which returned to positive territory as a constructive data point for U.S. equities of note. New orders have been a leading indicator for S&P 500 CapEx in the past. Given investor excitement over the One Big Beautiful Bill and its bonus depreciation and R&D provisions, we've been keeping a close eye on this indicator since company commentary on these elements of the tax bill has been rather light. And one more negative data point, flows to U.S. equity funds have clawed their way back to positive territory, but they're still quite weak relative to levels seen earlier in the year. When we zoom out, we think this is evidence of buyer's fatigue. Geographically, flows to European and German equity funds have also been slightly negative. Digging a little deeper, U.S. and European flows for both U.S. and non-U.S. domiciled equity funds have been weak, while global ex-U.S. flows have been positive but with deteriorating trends. Importantly, within U.S. equity funds, retail flows have faltered recently. Specifically, passive flows for retail investors into U.S. equity funds have turned slightly negative, reversing prior strength. Meanwhile, retail outflows from actively managed funds remain negative with a deteriorating trend. The deterioration in retail flows, sharp decline in net bulls in the AAII survey, and decline in Bitcoin all cause us to question whether retail investors can be relied on to buy dips in the short term. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.